Welcome back to Investing Talk Podcast.
Today we're looking at HIMS and HERS Health.
As usual, before we start, subscribe, like, and comment to this video to support the show, because today we are unpacking one of the most fascinating and frankly contradictory market setups you are ever going to encounter.
Oh, absolutely. It's a wild one.
It really is. We are looking at a fundamental tension that should have any analytical investor scratching their head. I mean, imagine you find a company that just grew its full-year revenue by 59%.
Right.
They are absolutely crushing their top-line numbers. But then, you pull up the stock chart and you see the price has collapsed by over 52% year-to-date.
Yeah, it is the ultimate paradox for growth investors.
Yeah.
And it is exactly the kind of puzzle we love to solve for you. When you see a disconnect, that severe explosive business growth on one side and a collapsing share price on the other, you are basically looking at one of two scenarios. Either the broader market knows something terrifying about the underlying business model that hasn't fully shown up in the quarterly earnings yet, making this a classic falling knife. Or, well, the market has completely overreacted to short-term noise and headline panic.
Which creates a remarkably rare valuation opportunity for anyone willing to look past the immediate fear.
Precisely.
And that is the million-dollar question we have to answer for you today. How do you reconcile a company that is undeniably scaling its operations at breakneck speed with a market that is aggressively dumping its shares? Are we looking at a fundamentally broken business or just a temporarily broken stock? Let's open up the books and pivot to the fundamentals.
So when you look at the sheer revenue trajectory, the growth narrative is undeniably intact. I mean, for the full year of 2025, they hit $2.35 billion in revenue.
That's billion with a B.
Right. To put that 59% year-over-year jump into perspective, they are essentially adding the equivalent of a mid-sized healthcare company to their top line every single 12 months.
It's staggering scale.
It really is. And that growth is being driven heavily by consumer demand for personalized health products, specifically their compounded weight loss medications. But it isn't just revenue. They also drove their total subscriber base up to 2.5 million paying users.
Which represents about a 13% increase year over year.
Exactly.
Okay, I hear those numbers. But as someone who constantly checks the data for hidden traps, I have to look under the hood of that growth. Let's isolate just the fourth quarter of 2025.
Sure.
The revenue was right around $617.8 to $618 million, which is a solid 28.4% growth year over year. And yeah, I see that their GAAP earnings per share, which is just the standard accounting measure of company's profit divided by its outstanding shares, came in at 8 cents.
Which absolutely crushed the Wall Street consensus estimate of just 3 cents, by the way.
True, it crushed the consensus. But here is where the friction points start glaring at you. Net income dipped to $21 million, and even more concerning to me is the gross margin profile. If we look at Q4, their gross margins shrank by nearly 5%.
Yeah, 487 basis points.
Right, 487 basis points for the finance nerds out there. Gross margins landed between 71.9 and 73.8%. Look, for a tech-enabled software and logistics platform, bleeding 5% off your gross margin in a single quarter is a flashing red light. Are they essentially just buying this top-line revenue at the expense of their actual profitability?
I get that. That margin contraction is absolutely the focal point for the skeptics, and it's a completely fair critique to raise. However, if we pull back the lens and look at the broader operational efficiency, there is a highly compelling counter-argument.
Let's hear it.
You have to look at adjusted EBITDA. Now, for those who might not live in financial spreadsheets every day, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's essentially a way to measure a company's core cash-generating capability without the noise of accounting quirks.
Exactly. And in 2025, their adjusted EBITDA nearly doubled to $318 million. Nearly doubled, yes. That metric tells you that while gross margins might be taking a temporary hit, likely due to the heavy upfront costs of scaling logistics and aggressive marketing expansion, the actual cash engine of the business is dramatically improving.
Okay, so the core engine is humming.
Right. Furthermore, the management team's forward guidance projects incredible confidence. For fiscal year 2026, they're guiding for $2.7 to $2.9 billion in revenue. That comfortably beats the consensus expectations, signaling 15 to 24% sustained growth.
Which is aggressive.
It is. And they have planted a very bold flag in the ground with a long-term target of $6.5 billion in revenue by 2030.
Guiding for $6.5 billion by 2030 is extremely aggressive. And to even have a prayer of getting there, management needs a pristine balance sheet. To their credit, their financial health is currently looking like an absolute fortress.
It really is.
We are looking at a company that ended 2025 with $577.5 million in cash and equivalents. That is a huge step up from the $300.3 million they had sitting in the bank previously. Even better, they're carrying zero significant debt.
Zero, which is rare for a growth company at this stage.
Very rare. They also generated $300 million in net cash from operating activities in 2025 alone. But what stands out to me is their capital allocation strategy. They aren't taking that free cash flow and returning it to shareholders through stock buybacks or quarterly dividends.
No, they are funneling every spare cent back into the business.
Exactly.
And they are reinvesting it directly into widening their competitive moat. That moat is built entirely on their sticky, tech-driven subscription model. Think about what it means to have 2.5 million active subscribers.
It's a massive recurring revenue base.
It is. These aren't just one-time customers who buy a product and disappear. They are generating an average of $83 in monthly revenue per user, and that specific metric is up 10.7% year over year.
Which is impressive considering the macro environment.
Right. That creates incredibly high switching costs. Once a patient is integrated into their digital ecosystem, receiving personalized treatments delivered to their door every single month, they rarely go through the hassle of leaving for traditional, slower healthcare providers or rival startups.
And they are taking that $83 a month from millions of users and using it to fund substantial expansion. We are seeing them roll out new testing initiatives, which provides them with vast amounts of data-led insights. Plus, they are branching heavily into specialized high-margin areas like menopause and testosterone treatment.
Yeah, the total addressable market there is huge.
It is. But the most significant move regarding their cash reinvestment is the $1.15 billion acquisition of Eucalyptus. That is an enormous play to open up entirely new international markets, specifically Australia and Japan.
It is a brilliant strategic maneuver.
Yeah.
By acquiring Eucalyptus, they aren't just buying another revenue stream. They are instantly globalizing their telehealth infrastructure.
Because Japan and Australia are highly lucrative but intensely regulated healthcare markets.
Just exactly. For a foreign company to build a telemedicine presence from scratch in Japan, dealing with local regulatory bodies and incumbent medical networks, it would easily take a decade of burning cash. By buying their way in through Eucalyptus, they are bypassing those hurdles and proving they have ambitions far beyond the domestic United States market.
Moving away from the balance sheet, let's pivot to the charts and technicals, because this is where the story gets really dark really fast.
Oh, yeah. The technicals are rough.
The recent price action has been an absolute bloodbath. I mean, in just 30 days, we saw a 37.8% drop, pushing the share price all the way down to $15.88. That brings the year-to-date decline to 52.5%. When a stock loses half of its market value in just a few months, it fundamentally breaks the psychology of the retail investor base.
It really does.
Every time the stock tries to rally, it immediately gets sold into by exhausted bag holders who are just desperately trying to break even and get out.
The short-term pain is severe. There is no denying the reality of that chart. But we have to zoom out and look at the structural history of the asset. Yes, it is down 52.5% this year, but if you look at the 3-year returns, you are still sitting at a very robust 66.5% overall gain.
That's a fair point.
This implies that we might simply be seeing a violent reversion to the mean, a cooling off period after an incredible multi-year run, rather than a permanent structural breakdown of the company. And we are actually already seeing signs of a bounce.
Right, early March?
Yeah, on March 2nd, 2026. Following those strong earnings results we just discussed, the stock surged 10.3%. That kind of impulsive upward move off a heavily depressed base often signals that the panicked sellers are finally exhausted and value buyers are stepping in. They're recognizing that a business growing top-line revenue at nearly 60% shouldn't be priced like it is heading for bankruptcy.
But the momentum and the trading flow behind that bounce are highly complicated. When you look at the options data and platform metrics, there is an absolute retail frenzy going on. They are consistently ranking as a top search on platforms like Benzinga Pro, which tells you retail interest is hyper-elevated.
Retail traders love volatility.
And this stock is providing it in spades right now. But we cannot just look at the retail crowd. We have to look at the institutional positioning, specifically the short interest.
The short interest dynamics here are fascinating and crucial for you to understand. Right now, the average short interest for companies in the broad Russell 3000 index is hovering around 7.5%.
Which is pretty standard.
Right, but this stock carries a substantially higher short interest. Now let's break down exactly what that means. You have a massive amount of institutional short sellers borrowing shares and betting against the stock, hoping the price will continue to fall.
Adding fuel to the downward fire.
Exactly. But given the high volatility of this asset, combined with the constant stream of platform expansion news, you have the perfect recipe for a potential short squeeze.
Walk us through that.
Well, if the company drops a surprisingly good piece of news, say an earnings beat or a new regulatory approval, the stock price jumps. Those short sellers suddenly start losing money, so they panic and buy back the stock to cover their losses. That forced buying accidentally creates a rocket ship effect on the price, driving it even higher.
It creates a very asymmetric risk-to-reward profile for anyone accumulating shares at these heavily depressed levels.
Precisely. The powder keg is primed.
Let's shift gears to sentiment. How is the market actually perceiving all of this? Because right now, the signals are incredibly mixed. If you aggregate the overall market mood, it registers as entirely neutral. But the actions of the Wall Street analyst are where you see true cognitive dissonance.
No, the analyst ratings are all over the place.
They are aggressively slashing their price targets, yet they are stubbornly maintaining their bullish ratings. For example, Barclays just took an axe to their price target, cutting it from $48 all the way down to $25.
A massive cut.
But they bizarrely kept their rating at overweight. Canaccord did the exact same thing, cutting our target from $68 down to $30, but maintaining a buy rating. Help me understand why an analyst would chop a target in half but still tell you to buy it.
It all comes down to career risk for those analysts. That kind of contradictory action usually means one thing. The analysts still fundamentally believe in the long-term mechanics and profitability of the business model, but they are absolutely terrified of the short-term headline risks dragging the stock down.
So they are covering their tracks.
Exactly. If an analyst keeps a $68 price target on a stock trading at $15, they look at a touch to their clients. So they lower their targets to protect their own reputations against the immediate volatility. But by keeping the buy and overweight ratings, they are winking at the market.
They are signaling to you that the underlying asset is heavily undervalued at these levels.
Right. They see what we call bullish undercurrents. They see the international tech platform expansion. They see the strategic entry into Canada. Those operational wins are quietly but actively offsetting the heavy legal noise that is dominating the daily financial news cycle.
And that legal noise is going to collide directly with the upcoming catalyst calendar over the next 3 months. We have to look ahead to late April or early May of 2026 when they will report their Q1 earnings. There is a palpable tension building right now between what the street wants and what management is promising.
The classic guidance gap.
Exactly. Consensus revenue expectations for Q1 are sitting between $645 and $653 million. But management's own guidance is intentionally sandbagged at only $600 to $625 million. That is a significant gap. If they come in right at their own guidance, it is technically a miss against consensus, which could trigger another brutal sell-off.
It is a critical earnings print, no doubt about it.
Yeah.
But you also have to factor in the broader macroeconomic trends that are heavily influencing how money flows into the sector right now. The broader market is currently rotating aggressively into healthcare, largely driven by the expectation of macroeconomic interest rate cuts.
Because cheap money changes the growth calculus.
Exactly. As capital gets cheaper to borrow, large institutional investors start looking for scalable growth again. And what is more scalable than a tech-driven telehealth platform? Think about traditional pharma companies. They are facing severe patent cliffs, meaning their legacy blockbuster drugs are losing exclusivity and cheap generics are flooding the market.
It's a heavy, slow business model.
Right. Telehealth, on the other hand, relies on software, recurring subscriptions, and efficient logistics. It offers a much more modern, scalable investment vehicle compared to the heavy capital expenditures and decade-long research trials required for traditional drug manufacturing.
We have to play devil's advocate here. Let's dive into the bear case and the speculative hurdles, because we cannot ignore why this stock was cut in half in the first place.
Fair enough. The risks are real.
The regulatory and legal risks surrounding this company are severe. We have to talk about the Food and Drug Administration. The FDA has been heavily scrutinizing the compounding of GLP-1 medications.
Which is a massive part of their recent growth.
Yes. For those who aren't familiar, GLP-1s are the highly popular, highly effective weight loss drugs that have taken the world by storm. The company has faced 30 warning letters regarding their compounding practices, and it is not just federal regulators turning up the heat, it is Big Pharma itself.
The Novo Nordisk lawsuit is the looming threat that bears are circling. Novo Nordisk manufactures the branded, patented versions of these incredibly lucrative weight loss drugs. Over the past year, because demand was so high, there were massive supply shortages.
And that opened a legal loophole.
Exactly. During those shortages, the FDA allowed telehealth companies and compounding pharmacies to step in and provide custom-mixed versions of the active ingredients to patients. It is kind of like if a world-famous bakery runs out of their patented secret recipe cookies, and a local shop is legally allowed to start baking knockoffs just to feed the line of hungry people out the door.
Great analogy.
But now, the famous bakery has restocked its shelves. The shortages are resolving. So companies like Novo Nordisk are aggressively deploying their legal teams, suing to protect their intellectual property and shut down the compounders. This directly threatens a highly lucrative revenue stream for the telehealth platforms.
Exactly. If the federal courts or the FDA force them to halt the sale of compounded GLP-1s, a substantial chunk of that $2.35 billion in revenue could evaporate overnight.
It's a huge cliff.
And that brings us right back to the financial misses we discussed earlier. If you combine the potential loss of the weight loss revenue stream with the fact that their Q1 2026 guidance is already sitting below consensus expectations, you have a very real, very dangerous risk of continued margin contraction.
Yeah, margins will get squeezed hard.
If the top line growth slows down and the margins keep shrinking, that $15 share price isn't the floor. It could easily fall into single digits.
Those risks are entirely real, and they are existential to a specific portion of the business. But as a savvy investor, you always have to ask yourself one crucial question. Is all of this bad news already priced in?
And you think it is?
I would strongly argue that a 52.5% year-to-date drop has already absorbed the vast majority of this regulatory fear. The market has essentially already priced the stock as if the compounded weight loss revenue is going straight to zero tomorrow.
Which is a worst-case scenario.
Exactly. But here's the fundamental counterargument, that the bears are completely missing aggressive diversification. The company is actively pivoting away from a reliance on weight loss drugs. They are scaling high-margin, non-weight loss growth verticals like dermatology, sexual health, and mental health.
Building out a broader ecosystem.
Right. And we cannot forget the eucalyptus acquisition we touched on. By scaling globally into sophisticated markets like Australia and Japan, they are building a geographic counterbalance that completely insulates them from domestic FDA pressures. They are essentially outrunning the United States regulatory storm through aggressive global diversification.
Bringing this all together, it's time for the final verdict. When we take all of this data, the FDA risks, the explosive subscriber growth, the technical charts, and the international expansion, and we run it through our analytical framework, we are actually looking at a highly compelling setup. We are giving this a solid 8 out of 10 on our quantitative bullish score.
And here is the multi-year investment thesis, your elevator pitch for the stock if you're considering a position. This is a company that boasts 59% revenue growth, a staggering subscriber scale of 2.5 million paying users, and a very clear management-defined path to $6.5 billion in revenue by the year 2030.
Despite the noise.
Yes. The regulatory risks regarding compounding are high, but at a current price of $15.88, the 50% plus pullback has created a severe undervaluation. If they can weather the FDA storm and continue to execute on their diversification strategy, the upside potential is tremendous. We classify this as a multi-year hold, specifically accumulating shares into the upcoming 2026 earnings catalysts.
It all comes down to management's ability to execute under pressure. But I want to leave you with one final provocative thought to mull over as you research the space.
Let's hear it.
If a digital telehealth platform can successfully pivot away from relying solely on blockbuster weight loss drugs, survive the legal onslaught of big pharma lawsuits, and build a self-sustaining global healthcare ecosystem right on your smartphone, are we witnessing the permanent unbundling of the traditional doctor's office? Will the next generation of patients even know what a waiting room looks like, or will all routine care be managed through a subscription app?
It is a fascinating question.
Think about that as you review your portfolio allocations this week. As usual, before we sign off, subscribe, like, and comment to this video to support the Investing Talk podcast. We will see you on the next one.